We agreed that our measure of money is currency plus demand deposits. So cash in your wallet plus the counts that you have at your bank that you take out on demand. So how did we put money into the economy? In a previous video, we showed that an open market operation by the Fed buys a bond, a U.S. Treasury, and it pays for it. Let's suppose it bought a $100 bond from the economy, which means it bought it from a single person in that economy. So there was a person who actually got the money. And now there's definitely an increase in the money supply of $100. If that person held it in their cash in their pocket and that was it, then money supply would just equal the currency, and there would be $100 increased in the economy. End of story. Most people don't hold all of their money in cash in their pockets. As a matter of fact, most of your money ends up back in the banking system. So if you get money in your pocket, if this bond trader gets the money, the first thing she's going to do is either deposit it in her bank so she can access it on her ATM card or her debit card, or she's going to take it and she's going to go buy something, like stop at the store on the way home and buy groceries. What does the store do with it? At the end of the night, they put it in their cash drawer. They deposit it first thing in the morning in the bank. One way or another, most of the money gets back into the banking system through deposits. So for simplicity, we're going to start by assuming nobody holds cash. They get money, they put it straight into the bank, okay? We'll later consider the case when they hold cash and make deposits. So let's look at the process. The Fed first gave money to a bond trader. Gave them $100. That bond trader, one way or another, makes a deposit at a bank of $100. What does the bank do with that money? They do two things. One, they're going to hold some of it in-house. They're going to put it in their vault so they have cash available. And the second thing they're going to do is they're going to lend the rest out because that's how they make money. They pay her some interest rate to convince her to make the deposit, and then they lend it out the other door at a higher interest rate to earn extra money. The amount of money that they hold in the bank on reserve is called their reserves. Let's suppose that the reserve ratio, the amount of money they hold in reserves, is 10%. That's called the reserve ratio. 10% of the deposit, it's reserve as a ratio of deposits. 10% gets held in reserves. The rest gets lent out. So they make loans of $90 and they have reserves of $10. Who got the loan? Another person. What does that person need money for? To buy something. When they buy something, it goes into a bank after they bought it. Or you get the money, you take out your loan, and the first thing you do is you deposit it in your account so you can go spend it. So one way or another, it ends up in a bank. So this person has now made a deposit of $90. What does this bank do? It holds 10% and it lends out the rest. This process continues, going out to different people who put it in banks, who hold some and lend out the rest, and so on and so forth. Each time the amount of money lent out gets smaller and smaller because some consistent percent of the deposits gets put in reserves. The reserves to deposit ratio is the reserve ratio, and I'm assuming in this economy it's 10% or 0.1, however you want to write it at this point, okay? Now, we can see if we stopped to count money and used this formula, we would have zero currency. But look what happens. We have this deposit of $100. We have this deposit of $90. This person made a deposit of $81. And it continues. It turns out if you add up all the deposits and they get smaller and smaller and smaller, you'll find out in the end this system has $1,000 in it. First of all, this should disturb you. Why? There's only 100 physical dollars that have been put into the system. Yet when we count money, there is $1,000 in the system. How can we figure that number out? The key is what goes into the banks and what gets held over here. So deposit 1 times 1 over the reserve ratio is the formula. This is called a geometric series. And it's the formula you need. So your money is equal to the currency plus whatever goes into the banking system. Sometimes I call this the injection into banking. In our economy, this is 0 plus the $100. 1 over the required reserve ratio is 1 divided by 0.1. That is 100 times 10 gives us the 1,000. This number is called the multiplier, the money multiplier or the banking multiplier. Be careful. 1 divided by 0.1 is 10, but that does not mean that 1 divided by 0.2, if the banks hold 20%, this is not 20, it's actually 5. 1 divided by 0.3 is 33, it's 3.3. 1 divided by 0.5, if they're holding half of it, is just 2. So be careful when you calculate this. What's the key? The money goes into the banking system. The fraction that gets held is important. The more reserves they hold, the less gets passed on to loans, so the smaller will be the money supply in the end. The less they hold as reserves and the more they pass along each time, the bigger will be the money supply. So in general, if you increase the required reserves or the reserve ratio, you will decrease the money supply. And if you cut the amount of reserves that banks are holding, you will increase the money supply. This is called the basic banking multiplier, and it shows the simple multiplication process to go from $100 to having 1,000 in the money supply total.